Time now for our special market voice as ED now continues to celebrate its 9th year anniversary all of this week. Manish Gunwani, who's CIO Equity Investments at Reliance Mutual Fund, joins us as our special guest this morning. Manish, it's great to have you on the show. And once again, I'd like to thank you for the long association we've had, for your relationship and support in helping us reach where we have.
Thanks for everything. Yeah.
Okay, let's get down to talking about the markets. And you perhaps, Manish, would be the best place to give us a sense of where things stand. We are halfway into the year, and I'm talking about the calendar year, that is, 3 months into the financial year, which essentially is the first quarter. So from a global standpoint and from a local standpoint, because, the calendar year is what global markets follow. For our local markets, we draw cues from the financial year, given the earnings profile. How do you see things stacking up?
So if you want to split it in two parts, definitely from the global side, we are seeing some challenges to India's position because we've seen the dollar appreciate sharply. World growth, while remaining reasonably strong, at the margin, the data from Europe, Japan and China is not that strong, which means that US continues to be the strongest performing developed market, which obviously implies that the dollar has a positive outlook as of now. Now, as long as dollar is so strong, you clearly will see stress on emerging market inflows. And to that extent, as of now, from a liquidity perspective, not so much from a growth perspective, clearly the global situation is a bit challenging. I think what's holding up markets is the micro, which is both globally and locally. I think the earnings outlook remains quite benign. So if you see the developed market indices like S&P 500 or the MSCI World, they have high teen growth in earnings, which for mature markets obviously very, very strong. And even in India, I think the growth outlook is not that big an issue, because even in the recent quarterly results, if you X out corporate banks, PSU banks and large corporate banks, the earnings growth has been relatively quite good. And over the next 2-3 years, when the credit cost of these banks normalizes, the overall index earnings to a mine for next 2 years can kind of compound around 18-20%. So the earnings outlook is relatively benign, but I think what's challenging is, one is from the global side, you're seeing things like the US bond yield curve becoming a concern about predicting a recession, or crude prices still remaining relatively elevated. And on the domestic side, again, you have the uncertainty of going into a very sensitive political calendar 6 months from now. So I think these are the challenges. And also you have to remember, in context, we had a very great year last year. So obviously from that base, any marginal disappointment tends to hit the market quite strongly.
Manish, hi, morning. So, given the kind of landscape and the picture that you're painting right now as to how globally and locally things are, would we have to resolve to the fact that it's going to be a range-bound and volatile next few months for Indian equities? And within that, would this divergence between large and mid caps remain so?
So it does look like a year in which volatility is going to be very high. Again, we also have to remember that from mid 2016 to end of 2017 was a very, very exceptional period in terms of probably the lowest volatility for many decades, and markets tend to kind of overcorrect. So one is that we clearly think volatility will be very high. Yeah, and in terms of returns also, given the base we had last year, uh, although this is becoming something of a consensus and therefore you need to be a bit cautious about the stance, but yeah, as of now, when you look around, the fact that valuations are mixed, obviously quality companies are very expensive, but there's not enough economic momentum to pull up the second rung of managements and business models. So some valuations are mixed, but on an aggregate basis, slightly higher than long-term averages. And you have a very mixed picture where earnings outlook is not so bad, but both global and domestic macro is a bit of a challenge. So yeah, it does look like a year where the returns can be quite moderate.
You've had a tough task at hand, Manish, over the last 3 months in finding opportunities where you can generate alpha.
So we tend to stick on to the themes we have largely. I mean, some of the themes we like are still the large corporate banks, more from a 2-3 year perspective that while we may see volatility in numbers in the next 2-3 quarters because of RBI provisioning norms, etc., I think over next 2-3 years, we're expecting credit costs to come down to close to long-term averages, and therefore we find those stocks quite attractive. We like a mix of sectors like pharma, some select stocks in consumer discretionary, although that space generally is a bit expensive. But obviously, there are a lot of segments where either the penetration is very low or the cycle has been very prolonged in terms of the down cycle has been quite prolonged, and some green shoots are emerging in some segments of consumer discretionary. Infra as well, some pockets of engineering, road construction, logistics. So there's a mix of these kind of themes.
So, Manish, like you're saying that there are still pockets within the side markets which are still sitting at expensive valuations, still waiting to correct. What is it that you would steer clear of from when it comes to the broader markets? And like you identified that there are pockets of opportunity within that. If you could get a little bit more specific as to what exactly do you like within the mid and small caps where you do see value emerging?
So where clearly the valuations are very high is one is staples, for example, consumer staples, and consumer discretionary. Clearly, again, although the issue with all this is obviously these are very high quality companies, but it's just that the price to earning multiples have expanded quite substantially. So on that landscape where we kind of seeing some value as, let's say, sectors like general insurance and even life insurance, which are relatively underpenetrated, third party logistics, which again is quite underpenetrated in India, and some NBFCs which are catering to auto, gold financing, again, where we think they have a serious competitive edge over banks. And to my mind, I think while the macro is challenging, I think we should also keep in mind that the good part is the outlook on crude seems to be that above 80 looks difficult because OPEC itself seems to indicate that they will increase production around that level. So if you were to place yourself, let's say 1 year down the line, my guess is the macro would not look that bad because We've seen a very sharp YOY increase in crude. On a currency basis also YOY it's depreciated. So the outlook on inflation, if the monsoon is good, which seems to be the case, is that food inflation could be relatively muted. Your inflation fuel probably 1 year down the line could be relatively muted. So the macro is not probably bad from a very structural sense, but more from this year's perspective, combined with the fact that we're clearly seeing these things like trade wars, etc. So just coming back to your question, things like insurance, logistics, etc., NBFCs, those are the spaces where we have some overweights.
Fund manager though, Manish, what is it that you're sensing within, the retail participants? Is there a lot of fear now? Are you seeing some redemption pressure come in for the small and mid cap schemes? And is there a clear and obvious choice now towards the large caps?
Not really. I mean, if you see the industry numbers for May, they're pretty good. So we're not seeing any sign of panic yet. I think, as I mentioned, I mean, you're seeing this year being challenging, but if you see the overall trend, and this is my view, is that India is also structurally, hopefully moving to a lower interest rate regime from a medium to long term view perspective, because a lot of the inflationary components over last 15-20 years, which is oil prices, real estate prices, I think next 3 to 5 year basis, a lot of these drivers of inflation will not be that strong. So the point is that it's unlikely that physical assets look very attractive in the medium term, whether you're talking of commodities, real estate, gold. So as long as that is the case, my sense is that while we may see some volatility in markets and which may affect flows sometimes, but that trend of financialization of saving, moving from physical assets to financial assets, I think that seems to be very strong at this point of time.
Manish, I was just going through details of the Reliance Growth Fund, and I know you can't talk specific stocks. I'm just going to outline what our research has highlighted, and maybe you could give us the investment philosophy driving returns on this fund. The recent buys in Reliance Growth Fund, as per our indications, are Emami, PNB Housing Finance, KRBL, Berger Paints, Exide Industries. What I take away from that is it's a mixed bag, but I think consumption is largely your play over here. You've increased holdings in Thomas Cook, InfoEdge, RBL Bank, Torrent Power. Decreased holdings include the like of Chola Investments, PTC India, and I think some of the recently exited names include an MRF, Century Textiles, Maharashtra Seamless. And on balance, your top 10 holdings have pretty much the same sort of allocation. So between 2.5 to at most 3%. Take us through how you're looking to balance out returns when it comes to Reliance Growth Fund.
So our philosophy in Reliance Growth is just to look at companies where we think over 3 to 5 years earnings can double, or obviously companies which are coming back from a down cycle, or high quality companies at a reasonable valuation. So if you look at the portfolio, the themes broadly again are sorry, things like NBFCs, where we see, as I said, a competitive advantage against banks, domestic facing pharma names, where the valuations are at a fairly big discount to FMCG names. Third is consumer discretionary, but more kind of hidden names where we think that these are not standard FMCG names more or less, but where we think that they are providing services to consumer companies, and the valuation is much cheaper than frontline consumer names. Insurance, again, where we think penetration levels in India are quite low. So if you see the portfolio broadly, a lot of names will fall into these kind of themes.
Right. Manish, have to ask you about, what your view on how critical crude as well as rupee could be as a moving part to the markets. We have that impending OPEC meet in Vienna over the weekend, and that hopefully should give us some more clarity on which way crude prices are headed. And the fact that the rupee is now plunged and we are almost headed in for an all-time low on the currency, well above that 68 mark. How big an irritant or dominant factor for the equity markets would you say these two legs are, crude as well as rupee?
So my view has been, rather than looking at crude, we should look at trade deficit, current account deficit, but current account deficit data comes with a big lag. The reason being that actually, most of the bull runs in emerging markets and India happen with rising crude prices. And the rising crude price obviously for India is negative, but the point is when world growth is strong, commodities will have a upward bias. And India also tends to do well when world growth is strong, because not only do you get economic growth, but the capital flows are very strong at that point of time. Now, what's been a bit of a disappointment over the last 2 years is the fact that Indian exports have not shown big elasticity to world growth. So you would have expected that India's share of global trade is about 2.5%. At that low base, given our size of economy and population, you would expect that we should be growing faster than global trade. But if you see the data over the last 2 years when world growth has been relatively strong, is that Indian exports have not outperformed global trade, which is a big disappointment in a sense. Now, what that does is then the role of crude increases, because if your exports are just growing at 8, 10, 12% when world growth is strong, clearly then the other part of the equation of trade deficits and imports, where crude is very high, and then any $10, $20 move in crude tends to push your current account deficit to that 2.5%, which is considered the boundary for becoming worried about current account deficit. So yeah, I mean, I think crude is obviously then very important, but the silver lining, I think, is that OPEC seems to indicate that they don't want oil price to be much above 80. Of course, any geopolitical situation can change that, but at this point, the positive for India seems to be that we probably have seen the worst of the crude move and it's behind us.
Manish, it's been such a delight having this conversation with you. We really appreciate you taking out the time to speak with us as part of our 9th anniversary celebrations.
Thank you.